I'll start with you because it feels like this week was a big reminder that geopolitical risk is still real, and it reasserted itself back in these markets. And I wonder how you're thinking about energy. As we were just discussing with Mike, it's not the entire story when it comes to inflation expectations, but again, it certainly doesn't help.
Yeah, definitely. Higher energy prices, higher oil prices has led to higher inflation expectations. And it's almost restarted this rout in global bond yields, if you will, with gilt yields, bond yields, as well as JGB yields rising in tandem. So geopolitics is definitely a very important factor in the price action in the bonds over the last week. And, add to that concerns about debt and deficits. I mean, that's something that's, again, back in the forefront. You discussed, the issuance coming from some of the hyperscalers. So in aggregate, you're looking at a lot of bond supply that the market has to absorb, and that's also pushing bond yields higher.
Yeah, and Subadra, I mean, just to finish that thought, I think that's a really interesting dynamic. The fact that, you have bonds dealing with all these different fundamental issues right now. And then at the same time, you have the technicals, which is in the form of massive corporate supply. And I wonder if that's, sort of crowding out some of these Treasury investments.
We had Treasury issuance as well this week. So yes, in aggregate, you're starting to see some level of concession that's built into the Treasury market. And that's what investors are demanding to take down the supply. The supply in general has been well absorbed, but you're getting a lot of supply coming from on the corporate sector. You're starting to see concerns about maybe a bit of a pushback in global bond yields. And that all kind of adds to the pressure that you're seeing in the bond complex. So it's a variety of factors that I think are pushing bond yields higher. Inflation expectations, as I mentioned earlier, is also pushing bond yields higher. Real yields are moving higher. The yield curve is starting to steepen out a bit. So this sort of move that we've seen in the last week is more of a bear steepener. And that is something that is a little bit of a change in the dynamic that we've seen, given the fact that in recent weeks, we've seen the curve somewhat flatten, and you're seeing some of that flattening unwinding.
Yeah, absolutely. And Vineer, I want to bring you into the conversation here, and just to start on the inflationary backdrop here, you think about some of the supply shocks coming through in the energy market. I mean, does the Fed have the tools to actually address what could potentially be going on when it comes to price pressures? Or, do they sort of lose their potency when you think about some of the factors we're dealing with right now?
Yeah, I think that's the big question. And to me, it is the question that should be on everybody's mind. I think over the last few years, maybe a decade, the Fed has pretty much lost control of the economy. I think they're doing a lot of things. They're obviously, moving short rates. They used to do forward guidance. That's now gone the way of the task force. So a lot of changes have happened. I think they largely do not have the tools, and the fact that their credibility and the fact that their record of forecasting inflation and controlling has been quite dismal over the last 5 years tells you that the market actually does not pay attention. So I come from a trading type of background, and I can tell you that, of course, in the short run, when they do something or say something, we all pay attention. Like a couple of weeks ago, when Mr. Warsh talked about inflation, and everybody was expecting him to talk about in a more dovish way. But largely speaking, the market ignores it. And I think they actually do not have the tools. They are pretty much cornered at this point of time.